Hey guys, how are you doing today? Hope you are good today. We're going to start today the trading in the option chain. And my name is Umesh, and I'm an option trader. From last 2 years, I'm trading an option by using the algorithms and by using the option chain from the exchanges as well as the broker. And I've used many brokers, and I have trained many people from last 2 years. So I build a team where people are involved in the trading in each and every day. But most of all, we are focusing on the data, because whenever the data is are in favor, then only we make an entry. Not like each and every day. And we are focusing on both option chain buying as well as in selling. So we're moving forward, and I'm going to in the next slide where we see what involves in the trading in the option chain. All right. So before we studying about the option chain, we comes to know about the concept which is involved in these option chains and the strategies and the risk management. This is the most important factor. So first of all, we're trying to understand the concept of this option chain. Then we try to understand about the strategies that is involved in this option chain, as well as the risk management, which is very important point, where we understand the position sizing as well as the type of the position that we make in the real market. So why trade options and the option chain? What is option chain? How the option chain are priced? Why trader use the option chain? See, option chain, first of all, it is involved the anatomy of this. First of all, we see the what is the anatomy of the option chain. The call versus put. Calls is buy side and put is the sell side, and strike prices, which is involved is expiries, bid and ask, volumes, and open interest. The Greeks, delta, gamma, theta, vega, rho. These are the factors involved in this option chain, and this is the anatomy of this option chain. So first of all, we understand the whole part of this. This is basically just like the human body, which is involved whole part, which is which involve all the movements. Similarly, this option chain also work on the basis of these 3 points. So how are we going to read the option chain in a practical example? So when we walk through the real or synthetic chain, we're going to interpret the price, volume, open interest, and IV first. And as you can see the example over here, that this is the at the money part, this is the in the money part, and in the money part, this is the in the money part, and this is the ATM part, where the at the money strike price. ITM is like in the money strike price, and OTM is like out of the money options, which is the theta value is very less, so its probability of giving price is very less, but people are using for hedging purposes. Like if you hedge, you have to buy the out of the money options, so that you have to keep on adjusting each and every time, each and every moment when price move from one part to another. This is the moneyness and time decay, where you can see that the price is moving upside. And ITM, this is the in the money, and which is the OTM, which is the outside of the money, and which is not involved that particular the price. The OTM have the very less theta on compared to ITM. So this is time decay is it's equal to theta, which is proximity to expiry, and implied volatility, and IV rank and percentile. IV percentile is plays an important role of for pricing the options. So what is the pricing? This is the pricing drivers and intuitions, the factors which is driving the options premium, which is the intrinsic value and extrinsic value, and the effect on the stock price movement on the options value is also one of the factor which is involved in this, and effect of the volatility changes. As you can see here, this is a gamma chart. See how it's look when you draw the gamma chart on the basis of the data. And this is the open interest. This is the change in open interest, 64% in upside and 36% in a downside. And this is the short positions and the long positions, which is the open interest basically. So this is the IV and we are comparing to the open interest. So this is the major factor which is involved in the moving of the pricing of the any stock, particular stocks on options value. So what are the major strategies that is using the option chain? Basic to the intermediate, we can understand the direction bet. As if we are betting on the buying side, we have to buy the call and puts, and as we can see the longs, the straggle and strangles. And liquidity, we are trading like focusing on the high open interest and tight spreads like okay. Neutral and volatility plays the iron condor and butterflies in calendar spread. This will neutralize the volatility. This is the neutral and volatility place, where we can find out which is the more volatile. So we have to neutralize the volatility. We will use such kind of strategies like iron condor, butterflies and calendar spreads. Okay, risk management factors, fundamentals. This is involve the position sizing, max risk per trade, risk control, the stop loss, a mental stop loss, how to set worst case scenario where we should be having the plan B. As you can see that how price is decreasing, then suddenly it will go for a confirmation that it will again reverse gear and it will go for another higher price. That means it's involved the price movement as well as the Vega. The green side, the red side, you can see which is red and green. This is the Vega and this is the time factor that is involved, and this is the straddle price, and this is the direction of this particular trade, and this is the prices. From green, this is again getting red, then from red again getting green. So we have to calculate all the data and bring out to the reality that what is the straddle point, what time it is get reversal, what price it is reversed. So we can take a stop loss of that particular point, or below that point we can take the stop loss up to the 50 points like that, and we can make a position on that, and we can play a long, or we can play a short on depend on the what data that we are getting on calculating all the data from the option chain. So practical to workflow from idea to trade, and screen of the liquidity, bid and ask spread, volume, open interest, and check the risk and reward factor, creeks and IV. Place the order types like and management, they like market versus the in limit and rolling and adjustings. All right, common pitfalls that involve in the avoid the dam. How are we going to avoid it? What will the common factor that we are lagging? Sometimes we are not able to see the trading illiquid contracts, ignoring the IVs and volatility regime, overlooking the theta decay in your expiry, and we are taking the trade. So we have to be psychologically very strong. We have to believe in the data. We have to run accordingly so that we can avoid the bad trade. We always choose the winning trade only, so that we keep on focusing on the profits, not on the losses. All right. So this is the real world example where we can set the examples and in live cases. But next time we're going to learn more practical about it. But how you going to practice? By paper trading and stimulations, and suggest exercise like identify the chain, compute the payoff diagrams, and run a mini strategies. Okay, this is the practical and formulas where we calculate all those, how much days of the expiries is remaining, and what is the theta and Theta and Vega is running currently. So how we predict the data, so we can find out our right positions and take an entry on it. So these are the factor involved. So thank you very much for giving me time for explaining this option chain. Next time we're going to run in the live data, and we're going to understand the data involves in this option chain, and we predict the right strategy accordingly. Thank you. Have a nice day.